You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 1:30 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. Welcome to the fun that is TWIFO, This Week in Futures Options. My name is Mark Longo from theoptionsinsider.com, as well as from the ever-present, ever-fun, well, at least we hope so, Options Insider Radio Network. And, of course, if you're listening to this, wherever you're listening to this, could be iTunes, could be our site, could be CME, wherever you find it, make sure, if you haven't done so already, you head on over there and you grab our full network feed. Get your all dozen programs out there. It's talking volatility, option block, options boot camp, daily news show, all that fun stuff. I guarantee you will not be wanting for options content. And while you're at it, if you like what you hear, if you want to throw a few stars our way on your platform of choice, a nice little review there on iTunes, wherever you listen, feel free. It always helps with all the search mumbo-jumbo on those platforms, which could be a little laborious at times. And, of course, for those of you who can't wait for the on-demand version, you got to have it live right now. We make it available every Friday, 1:30 Central, 2:30 p.m. Eastern, via Mixlr, MIXLR, so you too can see how the sausage is made. And, of course, however you listen live after the fact, make sure you hit us up. Questions, comments, insights, all that fun stuff. You guys know, we do like to hear from you guys. And joining me on the old program today, I got my usual cohort, my partner in crime, plus one. Let's start with my cohort here on the old TWIFO program, Mr. Nick Howard, the founder of Bantix Technologies and the creator of a little platform we use once or twice around here every week called Quick Strike. Mr. Nick, welcome back to the show, sir. How are things in Quick Strike land?
Hey, it's all good. Looking forward to our hot seat guest this week.
I don't know what you're talking about. It's just me and you here on the old show today.
I'm out.
You're out. Okay, you're done. You're done talking to me. You had enough talking to me. You want to have a hot seat guest. Yes, we do indeed have a guest in our CME group hot seat this week. By the way, if you guys are listening live and you want to follow along, generate your own report to see exactly what the heck we're talking about here on the show, head on over to cmegroup.com/TWIFO, TWIFO. That, of course, stands for This Week in Futures Options. And then you too can see exactly what we're looking at, run your own reports. If you're doing it after the fact, if you're listening to the podcast, make sure if you want to see exactly what we're talking about, you change those settings there to go for the last week, the previous week. Otherwise, you'll get through right till the minute that you're generating the report. So it makes it a little easier, a little fun for you to follow along either live or after the fact. And as Nick already spoiled the surprise, so we'll get right to it. We always have a fun guest in our hot seat. This week, we have another CME person in the CME hot seat, so that's appropriate. We have Jeff White, the Executive Director of Energy Products over there at CME. Jeff, welcome to TWIFO.
Hey, Mark. Thanks for having me on the show. Glad to be here.
And Jeff, as we are wont to do with all of our first-timers here on the old network, why don't you go ahead and give our audience a little bit of an overview of your background and how you found your way over there to CME Group.
Sure. So I've been at CME Group a little over 5 years as our head of energy options. And in my prior life, for 10 years before I joined CME, I was an options trader, specifically in the crude oil markets. I got my start on the NYMEX trading floor in the oil pits back in 2002. Traded on the floor for a while, moved upstairs to build out an electronic market making and OTC market making operation. Did that for 4 or 5 years before I joined CME in 2012.
There you go. Nice and to the point. I like that. Well, as we do every week, our friends over there at CME, they like to ask you guys what the heck you want us to talk about. So they put out a poll every week to their many, many hundreds of thousands of followers over there. Say, what should be their focus this week on This Week in Futures Options? This week they gave you guys 4 choices. They gave you copper, palladium, natural gas, and crude oil. The poll is still going, but it's pretty much winding down. Obviously, when showtime starts is pretty much the official end of the poll because we got to talk about something. So let's start with you, Jeff. No cheating, no looking at the Twitter yourself. What do you think? What do you think our audience, actually your CME audience there, what do you think they're voting for this week?
Well, considering there's an OPEC meeting this month, I'm going to guess WTI crude oil won the poll.
There you go. Huh? Interesting, Mr. Nick. Are you agreeing, or are you going to go? Are you going to go rogue? You're going to go palladium on me?
Well, I just give you my vote all the time. I voted crude for myself, so there you go.
There you go. You know you put one in for palladium too. Chicago, vote early, vote often. Yes, and crude oil taking it this week. 37% want to talk crude, so we'll of course start there. 27% want to talk a little nat gas. That's fun because we haven't really talked a lot of nat gas on the show before, and kind of appropriate that Jeff's here. So I guess it works out. If they had all said palladium, we would have been in great trouble. 23% want some copper, so maybe we'll get to that later. And if we can squeeze in your fan favorite there, palladium, only a paltry 13%. We'll see what we can do. Let's kick things off as we like to do a lot here in the old crude oil. What a week it has been, and as you mentioned, Jeff. This is obviously your bailiwick. What an interesting couple of weeks we have coming up. So maybe we'll start there. Obviously, you spend your days, day in, day out, talking all things energy options. I know crude is a leading part of that story. What's been catching your eye? What are some of the big trends and developments you've seen out there in the WTI options of late?
So, like we've seen in other markets this year, energy options, especially WTI options, have been plagued by consistently low volatility this year. Throughout the whole year, we haven't seen levels this low since probably 2014 when we were even lower than this. So despite that, we're seeing increases in volumes. While overall volume is fairly flat in crude options, the electronic volume is up 5% this year. And we're even seeing all-time record levels of electronic volume. We're 83% electronic this month alone in WTI options. we've come such a long way in the last few years when this market was heavily brokered. So really we're seeing a migration to the trade on screen. And, you mentioned, Mark, the OPEC meeting. So we have a pretty unique opportunity here to trade crude options around this OPEC meeting. Now, not just the vanilla crude options, which expired earlier this week, but we have WTI weekly options that expire the Friday, the day following the OPEC meeting on December 1st. So you're leading up to this meeting. There's a lot of uncertainty. You've got an option that expires the next day. It's the perfect hedge for whatever volatility comes out of the meeting.
Yeah, it's unusual that we see such a unique setup for this, but it does work out pretty well this month. Of course, as you're referring to, there is the big OPEC meeting coming up on Thursday, the 30th. So if you're trading regular monthlies or even, I believe, the spreads, you're kind of out of luck. They're all kind of off the board. That leaves you with the weeklies, and as we've said many times, weeklies have kind of been across the complexes there at CME, but it seems maybe particularly in a lot of these areas, weeklies are kind of the hot story. And have you seen a lot of uptake in WTI? Because it's kind of interesting, Jeff. I don't know if you know this, but on our show we've had kind of an ongoing discussion about the WTI weeklies in particular and why there's so much volume aggregated in the front month, and yet it hasn't always seemed to spill over yet into the weeklies. Are you seeing that trend changing, and what kind of trends are you seeing out there in the weeklies in WTI?
Yeah, we are seeing that trend changing, and you're exactly right. The weekly options across the CME options complex are a huge part of our business. You see in the mini options, it represents around 40% of the total options volume. In the treasuries, it's around 20 to 25%. But in crude oil, the weekly options really only represent less than 5% of the total volume. And then you're right, with a lot of trading in the near term, weeklies should be a bigger part of the market. But this year we've seen they have become a bigger part. So average daily volumes this month alone are over 4,000 per day. And we saw in 2016, average daily volumes were only around 1,000 a day. So we're almost, we're 4x the volumes we saw last year. So it's really starting to pick up this year. And if you look back at some of the previous market-moving events in the oil markets, like the OPEC meeting November 30th of last year, or the one this year on May 25th, we saw record volumes in the WTI weekly options. We saw 12,000 lots trade on May 25th this year on the May OPEC meeting. So I think traders are starting to introduce weeklies into their normal portfolio hedging. And going forward, it should become more a part of the standard trading. And we're hoping around OPEC meeting traders really realize how they can utilize these to hedge their portfolios from any resulting volatility.
Yeah, it's been one of the kind of the ongoing mysteries of this show, and we've talked to a lot of different people at CME about it. Blue, Eric, Derek, pretty much everyone we get on, we kind of ask their opinion. I'm glad I get a chance to ask you, the actual energy guy, about this, because it's one of the interesting things. Just the use cases of all these different products and how they shape up and how people like to trade them. It's always different for every different product, and WTI is no different. Speaking of which, before we run on with what's going on with WTI, you mentioned OPEC meetings. We talked a lot on this show last year. The last big OPEC meeting in November really seemed to be kind of a watershed moment for crude. Leading up to that event, we saw a period where pretty much all the bid was to the puts, and there really wasn't a lot of upside interest. People were concerned about continued downside movement in crude, and then we saw that event happen. Crude obviously rallied. We kind of shifted into this new kind of, I guess you can call it, bullish regime. We rallied north. Saw calls get a little bit more life, not a ton, but a little bit more. Puts a little bit less. We also saw volatility just take it on the chin out there in WTI. So it's been kind of an interesting year or so post that period. I'm curious, you've obviously been in the energy space for a while. What was that event, that big announcement last year of the OPEC cuts? What was that like from your perspective? Did you see a huge uptick in customer volume as a result? Were people really, was your phone ringing off the hook? Was it as big a deal for you as it was here for us on the show?
Yeah, to be honest, it was pretty wild. We had a record volume day right around the OPEC meeting, the highest volume day we've ever seen in WTI options at that meeting last year, and the monthly average daily volume was a record as well. So it really triggered record volumes for us on that vol spike. I mean, I was actually looking back at the constant vol maturity on Quick Strike this morning, and looked back at that vol move at the November 30th meeting last year. We went from somewhere in the 30s to a vol spike near 55%. I mean, that's a really high level historically for crude oil, and then saw it slowly come back down. But yeah, that vol event really drove volumes for us. So, the meeting this year, it's pretty highly anticipated. The OPEC members and other producers are going to debate whether to extend their agreement to rein in production, and well, if so, for how long. They cut production by almost 2% last year, and that really is what triggered that event. But there was really interesting news out this week where OPEC raised its forecast for global oil demand this year, while another agency, the IEA, cut their demand growth outlook for 2018. So you've got all these conflicting views in the oil market right now, which is even more reason why traders should be looking to options to hedge whatever risk comes out, because either direction, right, options can pay off.
Yeah, that's par for the course out there, right? But I was curious. Yeah, obviously that must have been a big time, I would imagine, for you as well. And we're still kind of dealing with the fallout of that nearly a year later. So it's kind of been interesting to see how that has really reshaped the conversation around crude. And speaking of that conversation, it's been an interesting one to watch out here. People have been debating, we said until recently, it seemed like that 52 or so level was a good prediction for a ceiling for crude. We broke through it a few weeks ago, been kind of trending north. People were thinking maybe we would even start threatening 60 out there. Some of that may be reflected in some of our options paper this week. Didn't turn out this week. Most of the futures ending the week unched or slightly off about half a handle or so, right around the 56.5 level or so out there in WTI. So for all those crude bills out there who were hoping for a sustained push north of 60 to end the week, didn't really happen. Vol coming off a bit as a result. We talked last week, hey, we got this. Finally, all you guys have been writing into us saying, when's the vol pop coming? When's the vol pop coming? It came finally last week, but we even said last week on the show, unless this move carries through in some degree, you're just not going to see this vol sustain itself, and that's pretty much exactly what we saw this week with vol, particularly in the front portion of the curve, really getting crushed out there again this week. So vol giveth and it taketh away, and it took away again this week. So still waiting for that moment when the premium buyers can have a sustained smile on their face out there in crude. And you're saying to yourself, well, that 60 drama, did that drive the paper this week? Yes, it did. In fact, a good week overall for WTI. Open interest up over 7.5% actually this week. So this product's always rocking and rolling on a given week. This week really lighting it up. Again, 7.6%. Of that, over half, nearly 60%, 58.5% coming in that front month, that contract, that Jan 2018 contract. And all this back and forth on the 60 strike. You're saying, did that drive paper again? Yes, it did. The 60 strike in Jan, number one with a bullet this week, lighting it up to the tune of 24,000 contracts, 24,351. So number one by quite a bit. Let's see, lighting it up the most here. Actually, today and Wednesday, 6,000 and change both days. The rest of the week kind of even. About 5,200 of that was opening this week. So a lot of opening paper on the 60 strike as people maybe were piling in, thinking, hey, we're going to make it, and then maybe also selling when they realized that we weren't. The double puts, though, also pretty active. We always talk about that kind of tight risk reversal / strangle out there in WTI in the front month. That seems where most of the action is in a given week, and that was the case again this week. This week it was 55.60, so the double puts also lighting it up to the tune of about 24,000 contracts. The lion's share coming on Tuesday, about 7,200 there. Of that paper, again, about 5,500, 5,600 opening, so a lot of opening action on both of these strikes. The 50 puts, though, not to be forgotten, they were kind of hot on their heels there, 23,000 and change of those as well. The lion's share almost half coming on Thursday, 10,000 and change going up that day. All that total, nearly 7,000 on the week opening. So a lot of opening paper, a little bit of a change this week. Last couple of weeks we've seen kind of unched from an OI perspective on these big strikes. This week, people are opening. So interesting stuff. Also probably a factor for Jan getting a little more active this week as well. Hence a lot of the opening out there. Then we drop off a little bit here to our next spot again on the put list, again in the front month, 52, so kind of splitting the difference there. 52 puts lighting it up to the tune of 16,000 and change. The lion's share coming on Monday with 5,000, a little less than the third, about total on the week, about 5,600 again opening out here. And as we like to do in crude, we always scan around for some fun outliers or interesting strikes that were lighting it up. This week we saw some action out there in April to the tune of the April 70s, lighting it up nearly 6,000 times this week, with the lion's share 4,400 coming on Tuesday. Pretty much all of that opening on the week total, about 4,500 contracts opening. So some interesting opening positioning there on the 70 strike. I haven't had a chance to dig in there, but it looks like on the surface it might indeed be crude bulls coming out to play there in April. And again, given the recent paper we've seen, 70 perhaps not quite as outlandish as it seemed a month or two ago. Also saw some paper, if you want downside, we got some paper on the downside as well out in March. The March 45 puts also lighting it up this week to the tune of nearly 10,000. The lion's share actually pretty evenly split on Tuesday and Thursday, about 3,600 each on both of those days. Almost unched from an OI perspective, a little bit shy of closing there. So perhaps some people coming in a little bit churn and burn there on those March 45 puts. Outside of that, weren't too many other extreme strikes or trades that were lighting up. Certainly not like the gold trade we saw a few weeks ago that was still just burned in our brains. Speaking of burning in our brains, Mr. Nick, I know you've been watching crude all week long. So any thoughts on the general state of crude here before we dive in? And then what are you seeing out there from a vol and from a quick strike, or a quick skew, I should say, perspective?
Well, the one thing I wanted to mention after Jeff finished up what he had to say was the thing that we always sort of bring up with the short-dated options as well, the weeklies, in particular when we see the big moves. And, Mark and I are always lamenting how the weeklies are a perfect opportunity to trade if it's 1 or 2 days left, especially when it's been sort of, maybe volatile is not the right word right now, but when there's been some movement in the market. The thing to keep in mind is these short data, especially on the OPEC, it's almost like you're trading a binary option. So you'll be able to make a purchase of these options that are going to expire in a day, and you're going to have some volatility value in there, but a lot of it is going to be, just how much that option is away from strike. So you have a real good chance to play around and almost trade like a one-day future with a real event volatility in place there to get yourself some movement in the underlying. So I always like to mention that, and that's why I always try to push the weeklies, because it gives you a good opportunity to get active in a volatile market without paying a lot of volatility value. Anyway, so that's kind of just my marketing plea to everyone, that I think they're missing the boat, because we see so many good opportunities in the weeklies across the spectrum in all the asset classes at the CME Group. As far as the other stuff going out there, if you take a look at the last week tab when you get a chance on the report, and you look at this week, you're going to see that for the most part, we gave back everything that we gained in terms of volatility. And Mark had mentioned that, but we gave back most of it or all of it and then some. So in particular, in the Jan and the Feb, I mean, those have nothing over the prior week. So again, we can't move out of these ranges. What happens? We trade down. People hopefully we tested that 55 level, which because of the open interest there and because of where we came from, if we broke that level on the downside, we maybe had an opportunity to keep going a little bit further. But again, it didn't happen. We bounced back up again a little bit, and we're up in the 56 and change level, and with a pretty flat futures curve. So kind of not good for the volatility market, but still, there's movement. You're talking about 1 to 3% movements in the underlying. So there is some stuff there that you can do. You just have to be active. I think if you are long, you have to be active with your gamma scalping and really try to pick your points as best you can. As far as, take a look, I pulled up the weeklies here just to see what it looked like from a open interest increase this week. And the front, the LO04, which is a 7 days to expiration, expires, obviously a week from today, and then the LO1Z, which expires 2 weeks from today. The 1 week option, we got an increase of almost 1,800 open interest overnight, so almost double the open interest. So it's a good sign, right? That short dated stuff is trading, and we're seeing it happening. And I think that now with the way the CME is presenting with the new, they have a quick options grid in there where you can just type in a future and you can get all the expirations associated with a futures contract instead of having to go and search for, the different things that are available as different products. I think it's going to be a lot better for people who are just looking for a short-term option to find something. They're not going to have to think, they're not even have to think about the weeklies. It's just going to show up in there as, hey, this is a 7-day option. So I think all those kind of changes are going to help. When we start to look at this, we said vol's down, gotten beaten down pretty good. And as Jeff mentioned, we're down pretty low outside of maybe where 2014 was. But then again, back then we were much higher in the futures. So, we're low here. But from a price range standpoint, we're probably in a similar price range, maybe a little less of a price range here from an overall volatility movement. But, the thing that's sort of catching my eye here a little bit in particular is the fact that, the puts, so far from the beginning of the week, we definitely got a bid in the puts and some offers in the calls. And now when I say that, I'm talking about outside of the 30 days. So we look at the 60-day contract, which is the FAB. The calls got offered and the puts got bid. So there was a significant shift in that 25 delta skew and or risk reversal. So again, not knowing exactly what's going to happen going into the meeting, but looking at the curve, it looks like we got a little bit of a bias to the downside, or like we've been talking about lately, we talk about movement along the vol term structure from a volatility standpoint, but we also can talk about movement along the vol curve itself within an expiration. So we're just kind of keeping the same shape, but we're kind of, if it's like you drop a marble into that volatility curve as you rock it back and forth, we go down, the volatility the skew might go up, and you go up, volatility, the skew might go down. So that's what I'm seeing right now. So still think that there's some good stuff going on out there. The skews are getting pretty wide here, so probably something to pay attention to as we go forward.
Thank you for that, Mr. Nick. We got a lot more energy to talk before we close the book here on WTI. Jeff, any last thoughts here before we dive on to some other products on all things WTI these days?
Yeah, one more point to add to what Nick mentioned. So he mentioned the week 1 December option that expires the day after OPEC, treated as a binary option, which is true. It captures any of the movement immediately following the meeting. But option traders should also remember that the week 2 option expiring a week after that could also be a potentially useful hedge, because as we know, if you look back at the history of these OPEC meetings or any market moving event for that matter, you see an initial vol move and price move, and then you'll see a resulting move after that. So traders who are looking to capture any of that resulting move the following week or hedge against that, the week 2 option is also an interesting one to keep in mind. And I was just using the This Week in Options tool to look at the week 2 option. And some new open interest opened up this week on the 52 puts, 55 puts, and 53.5 puts. 500 on the 52s and 55s, and 1,000 on the 53.5s. So 3 options nerds like us look at that and say, that's a butterfly, right? And when you're long a butterfly, you want it to settle right in the middle. So it's just interesting how traders are positioning that second week following the OPEC meeting, looking for the price to settle in around 53.5.
Yeah, like I said, we like to see more positioning in the weeklies. I mean, this is the time frame with that meeting falling right at the end of the week. It's just ideally situated. So if you've been listening to this show for a while, you kind of been on the fence about dipping your foot in the WTI weeklies. Maybe now is a good time to do so. Speaking of things you guys like to do, you guys have been asking us about nat gas for a while. So you asked for it, we shall deliver here on the old TWIFO program. I think we touched on it a little bit when Derek was on a few weeks ago or a month ago or so, but we haven't really given it the full breakdown treatment. Well, it's getting that this week because, there are other things out there in the energy complex aside from oil. Oil steals a lot of the headlines, but nat gas has been rocking and rolling. If you've been listening to our big movers and shakers on the end of the show every week, nat gas is in there quite a bit. Moving, gaining, losing. It's been moving quite a bit, so it's been an interesting product to watch. And certainly if you're looking for a little bit of vol, a little bit of action, a little bit of excitement, it's been an interesting product to watch. Before we dive into a full overview again there, Jeff, this is obviously probably the other product outside of WTI has taken up the most of your time over there these days. Break it down for us. What have you been seeing out in nat gas of late, and what are some of the big trends and developments out there?
Yeah, this is actually one of my favorite markets to discuss. So we've seen even a bigger trend in nat gas options of this move to electronic trading. So the natural gas options market historically has been dominated by professional energy traders, those who really knew energy and knew the nat gas markets. But what we've seen in the last 2 years, where 2 years ago natural gas options were nearly 100% brokered, traded as block trades, it has moved on screen more quickly than most other products. It was 57% electronic last month, and that volume's up 130% year to date. So what this means is that this market has now opened up to non-professional energy traders, just options traders who know how to trade vol. Now they get the full transparency of this market, know where the vol curve is priced, don't have to have the broker relationships, and want exposure to volatility, right? Like we look at nat gas implied vol right now around 45% in the 30-day option. Well, historically for nat gas, that's low, believe it or not. But relative to other asset classes right now, that's extremely high. So traders who are looking for exposure to more volatility in this depressed vol environment are looking to nat gas. And because now the market has really moved on screen, we're seeing more and more participation from new firms. And now is especially an interesting time in nat gas because it's a very seasonal product, where the winter season is typically the most volatile of the season. So here we are right now in the winter season. We've seen this vol creep up. So in it, we've seen vols as high as 65 and 80% and even higher over the years in the winter season. So it's an interesting time, especially now that it's liquid on screen. It's accessible to most traders.
Yeah, that is a surprising percentage. You think of a product like nat gas, and one of the reasons we weren't talking about it until recently is that, you just assume, you think of it in the kind of the old school fashion of, you're right, all brokered, kind of not a very accessible type product. But fast forward a few years, and that script has changed quite a bit. Speaking of script, you're right. That's kind of a repeated refrain we hear from a lot of our audience these days, particularly with traditional volatility sources like index volatility being just so anemic. People are hitting us up all the time saying, where can we go? What else can we trade? What else can we look at for any source of vol? And the answer for a little while now, it's been one of the choices has been nat gas. It's actually been moving. And, this is a product that some people, take a little while to get used to. The strikes are a little bit different. It trades in a 3 handle. So kind of the strike slices are more on like a fractional decimal kind of basis. So you kind of have to deal with that. People who are used to big index products or even maybe WTI with a little bit different type strike selection. So it takes a little bit while maybe to wrap your heads around the mechanics of what's going on. People get excited about a tenth of a handle move. It's so exciting, but that's kind of the nat gas world. In fact, that's exactly what we saw this week. Nat gas selling off about a tenth of a point, but that means it's right around 310. That's about over 3% move out there in nat gas. So that puts it on our movers and shakers list again for this week. Spoiler for a little bit later in the show this week that nat gas once again not failing to deliver on the movement front. And all that means, it's been kind of interesting from a vol perspective. We're seeing vol come off a little bit this week, but again, it's not surprising. It's kind of been pretty heavy out there. And again, it kind of depends where you're looking on the term structure out there. But net pretty much down slightly across the board out here in nat gas land this week. And we're saying here, it looks like this week from an OI perspective, things pretty active, up nearly 4% out there on the options for the week. And with the lion's share of that action, almost 50%, about 46% coming in the front month. Jeff, obviously you spend all your days in nat gas. Is that a pretty typical setup for nat gas? Do you usually see roughly half of the paper aggregating there in the front month, or is that more of an atypical setup?
So this is a trend that's developed over the last few years where, historically there's a lot of term hedging in nat gas with higher prices and more volatility and bigger spreads between the futures out the curve. We used to see a lot of term hedging, but in the last couple of years, as the forward curve has flattened, a lot of that volume in OI has shifted to the front. So really we see the bulk of the trading happening in the front 6 months. Typically we'll see current season plus some in the next season, and you really don't see a lot of active trading out past the front 2 seasons. So it's a pretty good observation. It's really a trend that's developed in the last couple years.
And Mr. Nick, I know we've touched on nat gas a little bit here on the show. I think most recently, like I said, when Derek was on from CME, but it's one that a lot of our audience, they write in quite a bit. It got a strong second place there in the CME poll this week, so people are clearly interested in it. And I know you've kind of been watching it off and on a lot of late because it's kind of hard to ignore. It's one of the more active things out there at least from a vol perspective on the Quick Strike platform. What are your thoughts here on all things nat gas options these days?
Well, I did want to throw a question out to Jeff because I think he's going to be in the best position to answer it. So for me, the interesting thing looking at the nat gas is the fact that, when we look at our quick skew numbers, we're actually seeing the curve kind of flip back and forth. And right now we have skew in the calls. Obviously we're heading into winter. And, if I look back at the end of 20 or the beginning of end of last year, the beginning of this year, we saw a big skew as well. And I'm going to go back just a little bit further just to see when that started, even more so. So, yeah, I mean, this is about the time we start to, and this is my question to Jeff, is this about the time we start to see really the call skew really kick in because of the uncertainty of what the weather's going to be? Because we definitely, we see it flip the other way in the warmer months, and now we're seeing it flip this way. And is this the type of stuff that people are trading, or do you think it's going to be the type that is the skew, this risk reversal collar thing? You think it's something that they're going to start to try to trade more so now that it's become more of a common or a more electronic based product?
Yeah, it's a good question, Nick. So, yeah, and I guess the winter season starts is from November to March, and then the summer is from April to October. So, the November contracts is front month in October. So, right around now is the time we start to see that vol skew, or the skew tilt towards the calls, because you're going into a volatile winter season with more uncertainty, largely driven by weather, right? The colder weather is going to drive the price higher. So we see the call skew steepen in the wintertime, and then as you approach the summertime, you see that call skew start to flatten a little and the put skew steepen. So it is fairly common, but it opens up the door for a lot of opportunities to trade, because if you look at the implied vol between March, the last contract in winter, and April, the first contract in summer, you see a vol spread of somewhere around 17%. Right, so trading any winter versus summer contract months really opens the door for some interesting trades. But yeah, it's pretty common. But as this market has moved more on screen, you may see less and less of sort of like these huge opportunities that have historically been when the market was opaque and sort of brokered, and now more and more traders can jump in there and with confidence trade because they have so much more transparency as to where volatility is priced and where fair value is. So it should be an interesting, winter season to see how it plays out, especially coming into the summer months.
Speaking of how things are playing out there in nat gas, let's dive into it again. You guys can play along yourselves. cmegroup.com/TWIFO. Just select the nat gas and then the European next to it. That's the one you want to look at. Some of the other ones are a little bit harder to analyze, but this one is where we're looking here. This is where the lion's share of the action was. Speaking of the lion's share of that action, it was up there in the Dees contract, the front month there, like I mentioned before, nearly half of the paper going up in that contract. As Jeff kind of alluded to, it's a little bit of a more recent kind of shift given all this moving out there to the screen and away from the old brokered action. And it's kind of interesting this week because we said it was kind of a bit of a sell-off out there in nat gas, hovering around that 310 to 320 strike out there, depending on where you're looking. And yet that's not where the lion's share of the activity was. It was actually a little bit north of that, the 350, 3.5 calls, lighting it up this week to the tune of 52,000 and change. So far and away, number one with a bullet out here this week. And it was pretty active out there on Tuesday. Nearly half of that paper, about 23,000 of those options trading on Tuesday, 10,000 today, 10,000 on Monday. The rest kind of scattered Wednesday and Thursday. Of that, a lot of volume, a lot of back and forth, obviously, on that strike. So clearly, nat gas traders are similar to WTI and a lot of other products where they like to cluster and aggregate around those even number levels. 3.5 clearly driving a lot of the attention this week. Only about 3,500 of that net closing, so a lot of back and forth on that strike. Maybe people hoping, wondering, won't they break that strike? Will it stay north of that when it didn't? Seeing a lot of paper coming off the other way. And close, hot on its heels was also the 325, the three-quarter calls out there, again in the front month, doing about 43,000 contracts. They're, again, pretty much almost half coming on Tuesday. Tuesday, obviously, the big day for call action in nat gas. 20,000 of those 43,000 contracts going up on Tuesday. The rest kind of scattered throughout the week. Net opening pretty strong this week on that strike, about nearly 7,000 opening on. So closing out on the 3.5s, opening on the 3/4, maybe people rolling down to some more, shall we say, relevant and realistic strikes. It was kind of all calls all the time this week. Number 3 is a 375, so you got a nice little strip. 375, maybe a little bit farther afield than where we're trading right now, but still seeing a lot of action this week. 38, nearly 39,000 going up on that strike. Again, Tuesday being the big volume leader, 20,000, so over half going up on Tuesday, followed by 10,000 on Wednesday, 7,000 on Monday, and pretty much not much the rest of the week, only 2 going up today. Net closing there as well, 5,700s, maybe a bit of a theme. People adjusting, rolling down from, shall we say, more optimistic strikes to something maybe a little bit more reasonable in the 325 range. Then we fall off a bit again. Actually, coming in after that, we got to go all the way that distance, all the way out to Jan. And actually, before we even get there, let's take a pit stop over there in the Feb contract, because if you thought 375 was outlandish, well, then Feb's got you beat. The Feb 4 call is coming in around the number 4 spot, 22,000. Those bad boys lighting it up, pretty much evenly split throughout the week, so no heavy bias on Tuesday there. A net opening of 5,000 contracts, so again, maybe bucking the trend a little bit, closing in the front month, 375, and then maybe repositioning for some extended upside there. The 4 handle, I'll let Jeff maybe weigh in on how realistic later a 4 handle is by February. He's the nat gas guy here, but still, shall we say, some optimistic paper lighting it up there in Feb. We also see it wasn't all upside, listeners, even though it was a lot of it. If we go back to Jan, kind of the Goldilocks contract in the middle there, we saw the Jan 275 puts also lighting it up this week, nearly 17,000 of those. The lion's share, pretty much half coming on Tuesday, 8,300 or so. The rest kind of scattered throughout the week. Net kind of slightly opening on the week for those, so no net bias there. But a lot of interesting paper kind of lighting it up across the board. I'm doing a quick scan here to see. Obviously, those Feb 4s are probably or I should say, actually more 4s. Actually, we're trading in March as well. The March 4 is also doing about 10,000 contracts. So the 4 handle seems to be pretty active out here. Looking for some other outliers outside of that. We don't see a lot beyond 4 pretty much, or south of 275 in either respect. Nick, this is an interesting one to watch. Like I said, we don't get a chance to really break down nat gas too often on the show, so it's kind of fun to sink our teeth into it a little bit more this week. You kind of touched a little bit on it earlier, but what's been catching your eye out here from nat gas, and kind of some interesting paper smattered across all the front months there?
Yeah, I don't have a tremendous amount of experience with the nat gas. I did have some friends that traded it for a while until it traded below 2 or around 2 for an extended period of time. So, and that shook the tree on even for a lot of experienced people that had come from other markets to trade the energy market, and in particular the nat gas. I want to throw one question out to Jeff. I'll just talk about the skew a little bit now, but I do have another question for him as well. You know, as I mentioned earlier, you know, the puts are offered and the calls are bid. You know, I think based on Jeff's comments just about how he thinks it might rein it in a little bit now that it's more of an open market and a little less opaque, I think that's something that we have to pay attention to as well, because, you know, our bias is towards sort of looking at the skew all the time, and this just has a very wide skew. And I'm going to actually, I'll throw out a report out here in a little bit, and so everybody could take a look at it and look at it over the last 4 or 5 years and see what the ranges look like. But you know, this kind of picture, when you see such width between the calls and the puts, it just begs to be paid attention to, as well as to possibly take advantage of. And you know, obviously, you know, more people you get in the market, the tighter some of those opportunities. You know, it might not be available so much in the future, but we've seen plenty of markets where there's been plenty of people for a lot of the history of the product, and you still sort of see those big expansive, you know, volatility spreads between the calls and the puts. So this one will be fun to watch to see if it continues to follow the seasonal pattern, and if it stays as wide as it has over the years from a seasonal average standpoint. So Jeff, as far as I went back and looked 5 years on the rolling front month, and we got some blips near 6. But I mean, is it pretty typical that we're within the? And I know we had the low point that I mentioned a while back when we were trading. You know, when it kind of was rough on the community itself when we were trading down below, and I specifically remember like some 180 handles and stuff like that, and I think 170 might have even been lower than that. But is it we pretty much between the 2 and 4 range, or is it over the last, you know, year? It looks like we've been between the, you know, just below 3 and and maybe 3.5, we kicked up at 4 at the end of last year. I mean, is that fairly typical?
Yeah, so I won't be predicting the price range, but what I will tell you is there's an expression in the nat gas trading community that it's not if volatility is going to return, it's when, right? So those of us that have been around the energy markets for a long time know every so often there are just, volatility events in the nat gas market. And most recently was back in 2014, I think we had what was called the polar vortex, right? That crazy cold weather pattern across all the U.S. that really saw that vol spike in nat gas. So there's really, the answer is there's really no typical price range for natural gas. It has been, in the last few years, we have been fairly range bound, around the 350 range. But, it's one of those products, right? That at 45 vol in a low vol environment, it's still very volatile. So there's still plenty of opportunities out there. And, traders typically don't take anything for granted in the nat gas markets.
Well, we kind of touched on it all, both of those products, really quickly before we move off some other stuff. Really quickly, there, Jeff. If you got any last thoughts you want to leave our listeners with, again, we don't get a chance to talk nat gas too often. Anything else you want to add? Then Nick, if you want to jump in after that, feel free.
Yeah, one quick point is sort of off topic of volumes is that because this product has moved on screen so quickly, it's only been recently that some of the retail brokers have offered the financial European style natural gas option, because historically it wasn't really screen traded. So for traders who have looked at these products over the last few years, they may be looking at the American style option, which is symbol ON. So be sure to look for the financial option, which is symbol LN. It does about 10 times the volume of the American style option.
Yeah, right. And I'll follow that up with it. I'm just looking now. The ON has about 150,000 in open interest, and the LN has over 2 million in open interest. So 2.5 million. So pretty tremendous difference there in terms of the sheer size, and then obviously the liquidity. But Jeff, if you listen to the show, you'll hear us talk about, because people are always sort of complaining about the no or low volatility market, and I always believe that, having traded vol and having had to look for things, I always think that a rangy product is also a good place to trade, even in a low volatility market, because I feel like there's definite plays where you can take advantage of the fact that it may not be volatile, but there is movement, right? So there's a little bit of a difference. So you're getting sort of range based movements where you're sticking between two pretty distinct prices, but that range affords you some things in terms of owning options. Lower volatility increases the gamma, which changes your delta a lot more rapidly, which gives you the ability to hedge your futures within that, or hedge the delta from your options with the futures a little bit more often than you might. So I agree that even, and I'm always from the ilk of preparing for the uptick in volatility, because a lot of people make their money being perpetually short, and it always is great when it's great, and then when you are on the wrong side, then it hurts quite a bit. So I don't necessarily say that it's time to be long volatility in these low volatility markets, but I always think that there's trading opportunities, and it even changes from volatility trading opportunities to gamma trading opportunities, right? Because a lot of times people always think short dated, low volatility are gamma options, long dated, high volatility are Vega or vol options. So maybe we're not trading the vol right now, but we're trading the gamma, and that might be the way to sort of make that point.
Now, we usually talk about surprise products of the week here on the show. It seems like all of them are, except for WTI, are pretty much surprise products, so you don't get to cover all of them, including 23% of you on the CME poll asked for copper this week, so we'll see if we could squeeze in a little quick copper rundown here as well. As you might imagine, copper, not the shiny stuff, so it doesn't do the volume of some of the other ones, but still interesting. It's kind of interesting you guys chose it this week as well, because this is one of the weeks where, last few weeks it's been moving and shaking. This week, not so much, pretty much almost unched on the week from an underlying perspective, right around the 307 or so level out there for the copper futures. Vol coming off a little bit this week as well, but again, not the rock'em sock'em robots weeks we've seen recently before. So interesting when copper got filtered up by you guys. In terms of what was lighting it up, again, copper quieter product than what we were just talking about. Open interest up 5% That's still kind of small compared to what we're talking about in terms of net volume. Some of the other ones like WTI and even nat gas out there. In terms of where the paper is pretty much all in that front D's contract, 75% of it. So very, very concentrated out here this week. And of that, if you're asking where the big action was, number one with the bullet out here is those 307 aforementioned, that strike, the at-the-money calls in the front month, 264. So that gives you a sense of what we're talking about volume-wise out here, lighting it up this week. The lion's share, over half, coming on Wednesday, and most of that opening this week. So, and looking down here a little bit more, also saw the 245 puts, 2.45, lighting it up, and the 3.15 calls lighting it up again. All pretty much all front month, all the time. Mr. Nick, don't have a lot. Actually, also worth noting a little bit farther out, we get all the way out here to the March 290 puts, also pretty active, doing about 230 or so, 2.90. So interesting stuff out here. Nick, we don't get a chance to talk copper a lot when people vote for it. Not exactly the most rock'em sock'em week, but anything catching your eye here before we roll on into some of their questions?
No, it's just sort of, you come off of the big open interest, big volume contracts, and then you come in here and you see a total of 13 or 14,000. It's always sort of hard to, this maybe it's just purely because it's a hedging market. I don't know, and there's not a lot of speculation, but not much to say. Vol's off a little bit, but the skew looks like it's pretty steady, or has been pretty steady. Over time, it calls a little bit bid and the puts a little bit off. It pretty flat. The puts pretty flat to the at the money. So that's always sort of something interesting to note too. When it's flat to at the money, so you just got kind of like a ski slope that you're looking at. So a little less steep in the calls this week, but yeah, not quite as exciting or interesting from my perspective. I do watch it though, because I do have about 100 pounds of copper sitting in the garage that I need to strip, and I think I got that when it was like $2.70. So I'm just waiting till it's about $3.50.
Is that a full contract? Can you do a full contract? Probably not 100 pounds. I don't think that'll do it.
It's sitting there, much to the chagrin of,
do a fractional, do a mini. See what you can do. See what you can do there for 100 pounds. Speaking of things that were lighting it up this week, let's get to our big movers and shakers, rockers and rollers of the week. Number one with a bullet this week, rough rice. Lighting it up, nearly 7.5%. Again, this is just pure underlying futures movement for the week. Not getting into OI changes or volatility. That's a much longer and more nuanced conversation. We're just hitting the big gainers and losers on the week. The big movers and shakers, about 7.5% on the rough rice. Corn, number 2, about 3.25% to the upside. Silver, 2.66. Platinum, number 4, 2.38%. No love for the platinum or the palladium this week. Gold, number 5. So all metals on the upside, about 1.5%. To the dark side, we got lean hogs and lumber duking it out for first place in the downside category, about 4.33% or so each. I think lean hogs taking it by a 100th of a point. The feeder cattle also off 3.5%. Number 4, nat gas to the dark side, about 3.25% on the downside. And then top 5 on the downside, we got RBOB gasoline off of nearly 3%, 2.92%. All right, it's time for you guys to take the wheel. Let's see what you got in store for us. It's time for your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/theoptionsinsider, stocktwits.com/optionsinsider, or via questions at theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody. Welcome to Futures Options Feedback. This is where you guys take the reins. Whether you're listening after the fact, you hit us up, or you hit us up on social media, or you're listening live. We like all that stuff. Like Aaron Snow here, listening live, got a comment here about nat gas skew. But it's crazy long, and I'm not sure what the heck he's talking about. So we'll save that, or maybe you rewrite that one and send it in. It's a lengthy one. I appreciate you listening live, but that's That's a little bit lengthy for here. Let's go on to, actually, this is a good one for everybody on the show here. Jeff, you can play along as well here. This comes from Last J. He says, hello, Mark and Nick and guest. Well, he was thoughtful. He included you as guest there, Jeff. So there you go. Loving the podcast. Well, welcome. Good taste there, sir, or Mr. or Mrs. Last J. He goes on to say, I'm new to crude, and I'm trying to wrap my head around WTI. You said WTI, the 6-month calendar spread, went backward for the first time in 3 years. I believe he's referring to, I think about 2 shows ago, we were talking about that data out there on the futures and that future spread getting backward. I think it was coming out of Reuters. They were breaking that down. So that's what he's referring to here. They go on to write here. So it's usually, that means it's usually in contango. Is there a good way to trade this reversion? Also, where is the spread quoted? Can I trade it on most major platforms? Well, this is a lot of energy here, Mr. Jeff. So it sounds like it's right up your alley. He's starting off. Let's touch on the first part first. So he's talking about the spread. You probably watched the futures, obviously a regular deal. Is backwardation out there in WTI? Is that a fairly rare occurrence? And then also, if he wants to know where he can get access to some of these WTI spreads, you got any thoughts on platforms for him?
Yeah, I'll take a shot at answering some of his questions. So, the crude oil markets do fluctuate between contango and backwardation, and lately we've been more of a contango market. It's actually, you look now, we're in contango from the front month contract out through 4 or 5 months out, and then we go into this backwardation. So there are a lot of opportunities to trade these spread differentials. So this question actually sets up perfectly for the calendar spread options. So we do have products called calendar spread options that are options on the spreads between 2 different calendar months in crude oil. And this is probably our second most actively traded crude option here at CME. It's symbol WA for those of you that aren't familiar with the product. But essentially the way it works is the strike prices are the spread differential. So for example, if the spread is 50 cents, the at-the-money strike price is 50 cents. And this is a product that recently has started to build up on screen with new liquidity. I think last month it was 60% electronic, which is also, this is a product that's typically brokered. So the question is, we see both backwardation and contango in the oil markets, lately more contango, but calendar spread options are the perfect tool to capture any of that price differential.
Yeah, I don't have much to add to Jeff's comment. The only thing I'll add is just sort of a non-trading thing, and it's just more of a vocabulary thing. I just don't, the contango and the backwardation, just they have to come up with better words than that, because it just is absolutely infuriating and frustrating to me. Even though I know what it is, I still sometimes have to think about it and explaining the naming. Maybe if somebody knows the reason, it's I guess I understand the backward, but it's backward from the thinking of contango. So it really is just a matter of, for me, I always kind of scratch my head as to why they named those 2 different shapes of the curve the way they did.
Yeah, I'm with you there. I've never liked that terminology. I mean, options usually get a lion's share of the scorn for having impenetrable terminology, but when it comes to futures term structure, descriptive terms, there are no slouches there either. You're right. Most people think backward. I think in the investing public, they think maybe backward towards the back portion of the curve. Nope, completely the opposite. So all sorts of fun stuff. We're kind of running up against this, so we'll see if we can squeeze in some quick ones here. Got some comments. Trotter asked us at the beginning of the show, could you please talk nat gas on the show this week? Well, you're a happy guy, Trotter. We spent a whole bunch of time talking nat gas. Hope you liked it, and we'll see if we can get more of it on the show this week. A bunch of people chiming in on the CME poll. J.R. Slaughter said, platinum, please. It's 10 times more rare than gold, sells at a 25% discount to gold. That ratio won't last. I don't think we had that as part of the poll. Maybe that's why he wrote in. Maybe we'll see. We'll see if platinum's lighting it up. Maybe we'll get it on the show in the future there, Mr. Slaughter. So good one there. And of course, Vionaz89 representing the masses out there who want Bitcoin. He says, Bitcoin, 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 more Bitcoin, Bitcoin all day. We just want a lot of Bitcoin. So a lot of love there still for that. Mr. Nick, any thoughts there on platinum before we roll out of here?
Yeah, I mean, just to make mention, and we talked about this a little bit late last year, or when they came out initially, there are gold platinum ratio futures and spread futures. So he should go take a look at those. And if he has an axe to grind, there's plenty of opportunity to do that with just the execution of one contract.
All right, everybody. That music means, unfortunately, we've come to the end. What an epic journey it has been in TWIFO land today. We started off talking WTI, as we were wont to do on the show quite a bit. Then we delved into some long-requested fan favorites like nat gas. Got to sink our teeth into nat gas. That was fun. And also copper. Don't get a chance to chat a lot of copper here on the show as well. And still people want more. They want platinum. They want palladium. Everyone's got their favorites. Don't worry. If it's active, we'll get to it, or keep bugging us, and maybe you'll break us there as well. But before we go, it was fun, Jeff, having you in the old hot seat today. And anything you want to leave our listeners with? Any hints, any teases for what's coming down the pike from you guys over there in the CME Group Energy Complex these days?
Yeah, one quick thing. Starting next year in 2018, all of the energy options they'll no longer have contrary instructions. So on the close in New York, it's going to be auto exercise right away. Simple product, simple to understand, starting in 2018.
There we go. That's a nice feature. People have kind of taken that for granted in a lot of other areas of the space, kind of this auto exercise feature. So yeah, if you want to, particularly a lot of people who are writing in today, they're saying they're new to WTI. If you want to get those people on board, I think automating a lot of that process is the way to go. Of course, head on over to cmegroup.com to learn more about the contracts. And while you're there, of course, hit the TWIFO page. Check out some of the quick strikes. Speaking of which, Mr. Nick, if they do that, what are they going to find? What's coming down the pike from the quick strike folks this week?
We putting a new build out there this week, and probably won't touch on that because it's more of the subscription-based stuff. But from the free integrated stuff that's available on the CME Group, I believe that this week, either I think at the latest Monday morning/afternoon, but probably prior to that, we'll see the product browser that we've been talking about. The product and expiration browser, where you can go and search for a product and get all the expirations associated with that, and download those dates and start dates and end dates and all that kind of thing in a really simple and easy to use tool. And then also to be released is the block trade browser, which again, same thing. It's going to be driven off the same sort of product browser, but you're able to get more information just on the different tools. So in this case, you'll see the block trades. They'll be grouped by the trades themselves, as opposed to just enumerating everything that went through the block engine. This one is going to tell you that it went through as a spread, or as a covered, or as a strip. So really like that. And it's got the prices. You hover on the prices, it'll tell you the settles. And that's going to only get better as we move forward. So product and expiration browser coming out, as well as the block trade browser, and very soon to an integrated CME web page, as well as to the quick strike tool itself, is the new spread builder, which is going to allow you to do some really just a lot better building of strategies, simulation of strategies, and also hedging your physical. So there'll be some great stuff coming in the next half of a quarter.
There you go. If you want to keep up with all the latest changes to the platform, as well as whatever else they're working on, head on over to Bantix. That's BANTIX.com. You can kick the tires and light the fires over there. And on behalf of Mr. Nick and Jeff, and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, subscribing, of course, for joining us live and sending in all those great questions. One of these days we have to do an all Q&A show. That'd be kind of fun as well. But you guys keep us busy with your product requests first, so we got to do those first and foremost. But hope you had fun, and we'll see you next week for more of This Week in Futures Options.
This Week in Futures Options is brought to you by Quick Strike, options pricing and analysis software. Quick Strike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. Quick Strike has you covered, with market data reports ranging from open interest to the term structure of volatility. Quick Strike is the perfect addition to your trading toolkit. Learn more about Quick Strike at Bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.